Trading Post FX, where the world learns to trade.
Welcome to the continuation of Module 4 of the Elliott Wave Vertical. This is Putting It All Together. In the previous learning object, we learned about rules, patterns, and probabilities, and the Elliott Wave trading map. In this learning object, we will learn about multiple time frame analysis and keeping a daily trading journal. Finish every day and be done with it. You have done what you could. Some blunders and absurdities no doubt have crept in. Forget them as soon as you can. Tomorrow is a new day. Begin it well and serenely, and with too high a spirit to be cumbered with your old nonsense. This day is all good and fair. It is too dear, with its hopes and invitations, to waste a moment on yesterdays. By Ralph Waldo Emerson, poet. I know for me, when I clean up yesterday's messes and mistakes, I can move on to today. Anything that I keep as baggage from yesterday affects my trading. When I have a clear head and am optimistic about the new day, my trading day is successful, no matter what. Happy trading. Multiple time frame analysis is key to understanding where you are in the wave count. The Daily Trading Journal with the daily checklist and daily trade plan firms up the trading plan for the day so that you are able to implement the Elliott Wave trading map with decisive actions. The goals of this final section are to learn the steps required to analyze a market using multiple time frame analysis. This is accomplished using the Daily Trading Journal, consisting of the daily checklist and the daily trade plan. This focus is imperative for trading success. Let's begin. When we begin with multiple time frame analysis, we usually start looking at the monthly chart to get a very long-term perspective. As we learned, the market moves in 5-wave patterns with the current trend in the current degree and corrects or consolidates the current trend either with a 3-wave move, a triangle, or a combination of 3-wave moves. Why does a market move in 5 waves? Think of the market psychology. Human nature appears to take longer to recognize a trend and get into it, so it seems that it will normally develop in a 5-wave pattern. In the currency markets, when there is no strong overriding trend, prices tend to rise and fall in 3-wave patterns. Within the Elliott Wave framework, this would translate into range trading, double threes, triple threes, triangles, and other consolidation patterns. As soon as a more lasting trend develops, prices should start to trace out a 5-wave pattern in the direction of the larger trend and should correct that trend in 3 waves. Consider this monthly U.S. yen chart going back 30 years. Since 1995 and for the next 10 years, the U.S. dollar yen trades within a 100 to a 150 yen range, and that range gets narrower and narrower as the descending triangle unfolds. This provides the initial perspective on the top-down approach. After reviewing this chart, we would then look at the weekly and then the daily, keeping in mind the monthly chart. Elliott Wave analysis is one tool that a trader can use in determining how he or she will allocate capital, just as we did with the Elliott Wave trading map. When used in combination with other tools, like all of the work we did to find the end of a trend, trading can be quite rewarding. Once you do your trading work, in case you are averse to doing homework, and determine where you are in the wave count, you must constantly review your work as time passes and new information is released. You may be able to confirm your view or possibly revise it. The new information provided might suggest that your initial wave count and view was correct, but that you might need to revise your timing or exact price targets. You must constantly monitor your positions against your assumptions. Just as we did, start out with the monthly chart to get the big picture and the big idea. Without that, it's like navigating without a compass. One of the ways to keep on top of a view and position is to develop a daily trading journal. The daily trading journal is a combination of a checklist and a trade plan. Once you complete the checklist and you plan the trade, you can trade the plan, but not vice versa. By defining what you see in the markets and the actions you plan to take, you are taking responsibility for your hard work. If your assumptions are wrong, you must respond to the changing market conditions and take action. Taking losses, by the way, is a necessary byproduct of trading because it is impossible to be right all of the time. Before you begin your analysis, you must determine what time frame you will be trading. As a short-term intraday trader, you will be looking at 5-minute, 15-minute, and hourly charts while trading off the 15-minute charts. As a medium-term swing trader, you will be looking at the 15-minute, hourly charts and daily charts while trading off the hourly charts. As a long-term trader, you will be looking at the 4-hour, daily charts and weekly charts while trading off the daily charts. Whatever time frame you are trading, it is important to look at 3 different time frames, one lower and one higher. By the way, the smaller the time frame, the greater the noise, which is why it is always good to look at a higher time frame to get perspective. In this analysis, we will consider ourselves medium-term swing traders, and we will look at the 15-minute, the hourly, and the daily charts. Part A of the checklist, daily chart support and resistance levels. The first part of the daily trading journal is Part A, the checklist, using the daily chart. When you look at your charts, you are not only looking for Elliott wave counts, but also for support and resistance levels, and key Fibonacci retracement and projection levels. First, determine the general and the daily trend. It's either up or it's down, and base it on the current trend. You can use a 5 or an 8-day versus a 13-day moving average crossover to determine the general trend. Second, review the news. Know what the daily releases are and how they will impact the market based on deviation from market expectations. When the news comes out, note the reaction. Third, plot long-term support and resistance levels. They can be former price highs and lows which you see, or pivot points which are calculated by a formula. Fourth, draw your Fibonacci retracements on the previous swing move. Additional retracements that analysts look at are 0.236 and 0.786, in addition to the standard 0.382, 0.5, and 0.618 levels. At this point, you may also want to draw your extensions, such as 1 and 1.618. Another extension that analysts use is 1.272, which is the square root of 1.618. This is where you can use your Fibonacci fans, circles, and time zones as well. For example, the time zones will show you if the recent price moves have Fibonacci relationships. The fans and circles have a time component as well. Part B of the checklist, Elliott wave counts on the daily chart. Determine where you are in the wave count on the daily chart and make your projections. Write it down on your chart and on the checklist. For each leg, determine what the measuring objective is and the actual price reached. Depending on where you actually are in the wave count will determine your next trade using the Elliott wave trading map. This checklist provides the inputs to your Elliott wave trading map, which was covered in the last section. Both go side by side. As you are filling this checklist out, you will need to look at the hourly and the 15-minute charts as well to refine the wave counts. For example, you know how to find point 0 or the start of wave 1. Go through the 6 confirmations and make sure at least 3 out of 6 confirm the end of a previous trend. For wave 2, determine your Fibonacci entry levels, but look at the internal ABC waves and refine your entry point. You will be doing this on the hourly and 15-minute charts. When you are in wave 3, you will be calculating how far it has traveled relative to wave 1. When it goes higher than 100% of wave 1, or more than 100% of wave 1, you will then look for 1.618 of wave 1 and then 2.618 times the length of wave 1. For wave 4, don't forget to look at alternation and the type of corrective pattern it is. Is it a flat, a triangle? Be specific. And for wave 5, it is very important to calculate the targets using the 5-wave sequence as well as the internal subwave 5 count. Also, look at whether it is a diagonal triangle, extended, or truncated. This is the determining point for the end of the trend, or point T. This is where you will take your profits and start to look for trading the new trend. Part C of the checklist, Hourly Chart Indicators. The next part of the Daily Trading Journal is Part C, the checklist, using the hourly chart. It is called drilling down when we go from the daily chart to the hourly chart. The whole approach is a top-down approach. Look at the hourly chart and take note of continuation chart patterns or reversal chart patterns. Continuation patterns will occur in wave 2 and 4 positions. Reversal patterns will occur at the end of wave 5. If you notice a pattern, draw the trend lines, note what it is under the Notes section, and type an X in the long column if the pattern is a continuation of an uptrend. If it is a reversal pattern, type an X in the short column because that means you are looking for the trend to turn around. Next, look at the moving average crossovers and type an X in the long column if price is above the averages, and an X in the short column if price is below the averages. Under Notes, take note of the price where the 813 average crossed the 21 and 34 period averages. Also on the hourly chart, you may want to add the 55 and 89-day Fibonacci EMAs. These averages are longer, so as you will see, they will get you into a trend after the 21 and 34 period EMAs. Next, look at the oscillator or momentum indicator. Look for divergences between the wave 3 and 5 for the end of the trend. Also, notice the large hump in the Awesome Oscillator and MACD during a third wave. When the histogram comes back to the 0 line, it means that the minimum requirements for a wave 4 have been met, and you are then looking for a wave 5 move to complete the sequence. Get to know each indicator that you are using because each one has its individual characteristics. Next, look for candlestick reversal patterns to give you a clue about the end of the third wave or a fifth wave. There are also candlestick continuation patterns, but again, that is the subject of another course. Don't forget to use your Fibonacci tool to draw the retracements on the last leg of the move. This will tell you where you are on the current move, as currency moves tend to respect Fibonacci levels quite well. Finally, count your Elliott waves. Part D of the checklist, 15-minute chart indicators. Before we complete the trade plan, let's complete Part D, checklist on the 15-minute chart. Do the exact same thing that we just went through on the hourly chart. Look for patterns and make notes. Look at the EMA crossovers and take note whether you are long or short. Look at the oscillators for divergences, and look at the candlestick patterns. Also, use the Fibonacci tool to calculate retracements on the last leg of the move. Part E, Trade Plan, Hourly and 15-minute chart. Part E is the trade plan. This is all about pulling the trigger. The checklist and the chart analysis is the research that we do in order to be able to complete the trade plan. Once we plan the trade, we trade the plan. Completing a trade plan, which is the trade plan for the Elliott Wave trading map, enables us to remove emotion from the trade and not get caught up in the psychology of wave personalities. It is crucial to your success as a trader. On a personal note, whenever I do not complete a trade plan, my trade is doomed to failure. Why? I forget why I entered it to begin with. I'm not certain about the price targets, and there are numerous other reasons. Most importantly, it is usually because I am emotional about a trade. Recall the general and the daily trend that you noted from the daily chart. If they are both up, it makes sense to look for a buy entry. If they are both down, it makes sense to look for a sell entry. If they are mixed, take a view, but take a smaller position. In other words, if the daily chart is bearish, but you want to buy for an intraday rally, take a smaller position. For this example, assume we are in a wave C down of a wave 2 ABC correction. At this point, we look to buy the wave 2 down for the third wave up. However, if we do that, our stop loss has to be below the bottom of the start of wave 1, which in this example is 113.42. Assuming we buy our wave 2 correction at 115.66 or 115.14, that is more than you might be willing to risk on a trade. However, if we look at our 15-minute chart where we can fine-tune the move, we might find a better entry level. The trade plan is specific. Use the Elliott Wave trading map as a guide for the number of lots to trade given where you are in the wave count. Define your entry strategy on the hourly chart and confirm price action on the 15-minute chart to enter trade. Be clear about your entry requirements under the notes column. What is telling you to enter this trade? Look at the Elliott Wave count in addition to the MACD, moving average crossover, trendline break, continuation chart patterns, and reversal chart patterns, and 1-2-3 formation. Determine your exit strategy, your stop loss price, and your profit levels. State in words what you expect to happen and how the market should behave, i.e., is it impulsive or corrective? You have done your research and analysis, and you have taken your position based on your Elliott Wave trading map, combined with the daily trading journal. Congratulations! You have your trade plan in place. Now monitor your position and good luck. Finally, when the trade is complete, note the pip and dollar profit and loss. Take note of lessons learned as well. You have come a long way on your journey to learning how to trade the Elliott Waves. In Module 1, you learned the basics, the building blocks for success. You learned about the rhythms of the Elliott Wave, wave pattern or form, Fibonacci, wave personalities, and how to count waves. In Module 2, you learned about impulsive wave structures, including diagonals, measuring objectives for impulse waves, and finding the end of a trend. Module 3 talked all about corrective sequences and alternation possibilities. You learned about zigzags, flats, triangles, and double and triple threes combined patterns. And finally, Module 4 taught you how to put it all together with the Elliott Wave trading map and trading journal. In Module 4, we learn how to navigate the waves with the Elliott Wave trading map. Here we learn about money management and using the rules to enter and exit positions. We learned 3 setups on different time frames depending on our tolerance to risk. We learned a system of cutting losses short and maximizing our profit potential. The final piece to this puzzle is implementation, putting it all together. It's so easy to come up with trade ideas, but without a written plan, the idea is gone with the wind. This is where the Daily Trading Journal comes in with its 2 components, the checklist and the trade plan. With the Elliott Wave trading map and the Daily Trading Journal, we are well on our way to reaping the rewards from our dedicated learning. With the knowledge of the tools learned in these 4 modules, any student can perform expert Elliott Wave analysis. By studying patterns and watching how the various markets unfold, you will be able to recognize patterns. Practice and study means labeling the charts every day. Start with the daily and move down to the hourly and the 15-minute. Remember, there are always 2 possible wave counts. Go with the most valid count, but just know that there is an alternative count that can be helpful in adjusting to the unexpected events. Using Elliott wave analysis, it is often possible to make money even when you are in error. For example, after a low that you thought was the absolute bottom, you might realize at a higher level that the market is once again vulnerable to new lows. A clear-cut three-wave rally following the low, rather than the anticipated 5 waves, gives you the signal that we haven't seen the bottom yet. That is why it is important to count 3-wave and 5-wave moves, even if you don't know exactly where you are in the wave count. Once you internalize the waveforms and personalities, it will be forever with you, just like learning to ride a bicycle. At that point, you will have confidence as to where you are in the market. This knowledge can prepare you psychologically for the up and down moves that will now make sense to you. Instead of guessing which way the market is going next, you will have an Elliott wave trading map and a systematic way to navigate the waves. Your Elliott wave solution. You have been given a toolbox within which you have the answers to many questions. You have learned the building blocks and can now fit the pieces of the Elliott puzzle together. Learning to surf the waves is like learning to ride a bicycle. You must feel like you just climbed to the top of a mountain. Keep practicing and you will hit the bull's eye over and over again. Happy trading!